Today I would like to analyze General, one of the largest retailer in America and one of the worst performing stocks in the last 5 years. We are down around 40%. But if we're going to take a look at the 6-month chart, we can see we are up around 40%, so one of the best performing stocks. So one of the reasons for that is they just announced the earnings, they had the higher earnings per share than expected, and also the revenue was higher than expected. So overall this looks very interesting, so we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 24.39 billion US dollar. This makes General the 30th largest retailer in America. We also have a dividend yield of around 2.43%, which we can see here did grow in a very good rate in the last 10 years. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. In 2021, the revenue was around 34.7 billion US dollar. This was a very good growth rate, around 21% from 2020. In 2022, we saw the decent growth around 1.4%. In 2023, we saw the good growth around 10%. And then in 2024, we saw the decent growth again around 2%. So overall, we had a good revenue growth in the last 5 years, so it's a check here. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2021, the free cash flow was around 2.85 billion US dollar. This was an incredible growth, around 96% from 2020, so related to COVID. In 2022, we saw the decline around 36%. This is also understandable because the year before we saw the very good growth rate. Then in 2022, we saw again the decline around 76%. This is something we don't like to see. In 2024, we saw the comeback with a growth around 63%. So overall, we didn't have a good free cash flow growth in the last 5 years, so it's not a check here. But if we're going to take a look at the gross profit, we can see actually we had a growth from 2021. It was around 10.72 billion, and in 2024 it was around 11.72 billion. So this is something positive. It means the business is still growing. So why we had the free cash flow decline? This has different reason actually. So we see we have the capital expenditures increasing from 1 billion in 2021, around 1.7 billion in 2024. So this is a big increase. We also can see a change in inventory. This company is buying more inventory. So overall, I think this company investing in the business, so it's not a bad thing. The next thing we're looking for is a free cash yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024, 0.69 billion US dollar. We're going to divide it with the current market cap, 24.39 billion. Then we're going to get the free cash flow yield for 2024. This is around 2.82%. So this is under the 4% that we're looking for, so it's not a check here. But we can also take a look at the future assumptions of the free cash flow. In 2025, the free cash flow could be around 1.68 billion US dollar. In 2026, around 1.27 billion US dollar. And in 2027, around 1.4 billion US dollar. So let's assume for 2027, 1.5 billion. Then we're going to divide it with the current market cap, 24.39, and then we're going to get the free cash flow yield for 2027 with our free cash flow assumptions. So the number we're going to get would be around 6.15%, and that's quite good. Actually, it's over the 4% that we are looking for, and this can be an indication for undervaluation. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with the free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first you're going to take a look at the long-term debt. We can see here around 6.23 billion US dollar. Then we're going to add the short-term debt as well. So the short-term debt is around 0.77 billion. Then we're going to divide it with the current free cash flow, 0.69. And then we're going to get the debt to free cash flow ratio for 2024. So the number we're going to get would be around 10.14. And that's not a good number actually. It's over the 5, so it's not a check here. It means a little bit over 10 years we can repay the debt with the free cash flow. So of course we have the higher free cash flow assumptions for 2027. We can also calculate this number with these assumptions. So then we get a different number. So the number we're gonna get with the different free cash flow assumptions would be around 4.66. And that's a better number actually. It's under the 5 that we're looking for, so it would be a check here. We can also take a look at the cash on hand, how much money this company has in the bank. We can see here around 0.54 billion US dollar, and this is also a decent amount. So overall, I think the balance sheet is decent, but only if they can have the higher free cash flow in the future. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, we're going to calculate the enterprise valuation. So this is the current market cap, 24.39 billion. We're going to add the debt as well. This is around 7 billion. We're going to take minus the cash, 0.54 billion. And then we're going to get the enterprise valuation, so how much the whole company is worth. So the number we're going to get would be around 30.85 billion US dollar. Then we're going to divide this number with the current free cash flow, 0.69. And then we're going to get a ratio that we're looking for. So this number would be around 44.71. And that's actually quite high. It wouldn't be a check here. It could be an indication for overvaluation, but of course we have the higher free cash flow assumptions for 2027. So let's calculate this number as well. 1.5 billion. So the number we're going to get for 2027 would be around 20.56. And that's a decent number actually. It's under the 25, so this could be an indication for a fair valuation. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially we think the company is undervalued. So we're going to take a look, and what we can see here, yes, this company did a lot of buybacks. We can see here in 2014 around 5%. And also the other years over 3%. So this is a very good buy rate. So they're buying back a lot of the shares. We like to see that, and this is a check here. Can Dollar General stock be a good buy right now? One of the best performing stocks in the last 6 months. We are up around 41%. So let's start with a positive about this company. We had a decent revenue growth in the last 5 years. The balance sheet is also looking decent, but only with the free cash flow assumptions for 2027. So the debt amount is quite high actually. The free cash flow yield around 2.82% is also not very high. We don't like to see that, but with our free cash flow assumptions for 2027, the free cash flow yield would be around 6.15%, which could be an indication for a fair valuation. Our enterprise valuation to free cash flow ratio around 44.71 is also quite high. We want to see that number under 25, but with our free cash flow assumptions for 2027, this number would be around 20.56. The positive thing we like to see as well is the stock buybacks. This company buys back a lot of their shares. This can help the stock price to increase. We also have a dividend yield of around 2.43%, which had a very good growth rate in the last 10 years. What we don't really like to see is the bad free cash flow growth. So this was very inconsistent in the last 5 years. But overall, I think this company could be a fair valuation right now, but only if the free cash flow can continue to grow in the future. If you found this video helpful, don't forget to like and comment and subscribe for more content.